All right, it's the month of June and we're back sitting down with Brett from Trinity Financial. Excited to be here. We're kind of, jumping off what we were talking about last week, and that's that late in life divorce.
Late in life divorce, yeah.
But now we're kind of talking about that investment allocation
Right.
after the divorce. So does divorce usually change risk tolerance was one of the questions that I wanted to ask first today.
Well, it does because pre-divorce, you had two people,
Yep.
and especially if they're working, you had two different portfolios, so you could have a totally different risk tolerance, if
Okay.
you will. So you could be more aggressive if they wanted to. They weren't focused on if they lost anything. Now all of a sudden, boom, a divorce happens. You have half the assets, half the income,
Yeah.
and people become very concerned. How do I make this money last as long as I do, in life? And then the question comes down to, do I have to be more aggressive to make up for lost assets? Or do I be more conservative to protect what I have?
Okay.
So if they're more conservative, that's counterintuitive to what they have to have, because we still need the growth to provide the future income.
Right.
If they get too aggressive, then during a downturn in a market, they can lose the assets. So it really becomes a balancing act, but it's finding those vehicles that give them peace of mind, give the divorcee peace of mind that it will still accomplish their investment goals.
Absolutely. And when you're using the term, aggressive, if you kind of want to go into more detail on how, being too aggressive can maybe create a risk, kind of given some more insight into it.
That's a great question,
Yeah.
because within Trinity, I would say that we're a very conservative minded investment
Okay.
philosophy. We use mutual fund portfolio, and then we use, if people want income or protected assets, we'll use fixed index annuities. But on a mutual fund portfolio, there are different degrees. You have your large cap growth and income. But there are assets or funds that are more aggressive, like, if they're new world or new technology, or, they're smaller in companies minded. Those are the more aggressive. I like to stick with the growth and income, which are considered to be more moderate in the growth world.
Yeah. And so obviously, would you say being more moderate has maybe a kind of better outcome? Let's say Trinity helping the divorcee using that more moderate outcome rather than aggressive tactic?
Again, another great question. I'm glad you did that, or asked that. Because if you take a look over the long term, 10 to 15 years, Alyssa, almost every growth-minded mutual fund has a 10 to 10.5% average annual rate of return.
Okay.
Doesn't matter how aggressive it is. So people, they seek for this aggressiveness, they seek for this wild growth, because they'll see some years where there's big growth, but there's also large losses, but everything averages out.
Got it. Okay.
So that's why we stick with the more moderate, the more consistent growth and income type of funds.
So does that apply to, because my next question for you was looking at a holistic plan for the divorce transition. Does that kind of go alongside that, or what does that look like?
So the holistic is starting with, what are you going to have for Social Security? What are you going to have for pension? Because those are the protected income sources, sources they can't outlive. And will that supply enough money to cover your lifestyle needs? Right. If not, then we focus on the investment portfolio, and how much of that do we have to allocate to provide the income, and then long-term growth.
Right, absolutely. So that way, that person can have a sense of mind, that money will last as long as I do.
Right.
Absolutely. Well,
and still have some for growth.
Still have some for growth. Look at that. And Trinity Financial, like we say every month, they're there to help you through all these. So you can go and visit them in person. The location is on your screen, or you can just call their number, which is 815-288-5800 again, or you can just visit their website. Brett, thank you again for sitting down with me today, and we'll be back after the break.